Hey everyone, it's Infinite Income Lab. Welcome back to the channel. Today we're talking about investing, and more specifically, the mistakes that could be costing you serious money. Look, I get it. Investing can seem complicated and even a little intimidating, but it doesn't have to be. We're going to break down 5 common investing mistakes that could be holding you back from building real wealth. We're going deep on these mistakes, so you know exactly what to avoid and how to set yourself up for success. Let's get started. Today we're diving into the 5 biggest investing mistakes that cost people thousands of dollars. Make sure to watch till the end to avoid these costly errors. This is a big one, guys. It's something that can make or break your financial future. One of the biggest mistakes I see people make is waiting too long to start investing. They often think they need to have a lot of money saved up or wait until they are older and more established. But that's just not true. The reality is, the earlier you start, the better off you'll be. You don't need a huge sum to begin with. The magic of compound interest is that the earlier you start, the more time your money has to grow exponentially. It's a powerful force that can turn small, consistent investments into substantial wealth. It's like a snowball effect. As your investments grow, they generate earnings, and those earnings generate even more earnings. Even small amounts invested consistently over time can add up to significant wealth down the road. It's all about being patient and letting your money work for you. Let me give you an example to illustrate this point. Let's say you start investing $500 a month at age 25. You might think it's not much, but it adds up. Assuming an average annual return of 7%, you'd have over $1 million by the time you hit 65. That's the power of starting early. Now let's say you wait until you're 35 to start investing that same $500 a month. You might think 10 years won't make a big difference, but it does. You'd end up with less than $500,000 by 65. That's a huge difference. Those 10 years can cost you hundreds of thousands of dollars. The point is, time is your greatest asset when it comes to investing. The earlier you start, the more you can take advantage of compound growth. The sooner you start, the more you benefit from the power of compound growth. Don't wait. Every year you delay is a missed opportunity. Start small, be consistent, and let time work its magic. Your future self will thank you for the decisions you make today. Listen, trying to time the market is like trying to predict the future. It's a gamble, and more often than not, it doesn't pay off. It's incredibly difficult, even for professional investors. They spend countless hours analyzing data, yet still struggle to get it right. Even the most experienced traders can't consistently predict short-term market fluctuations. The market is influenced by countless unpredictable factors. You might get lucky once or twice, but in the long run, it's a losing game. The stress and anxiety of trying to time the market can take a toll. Instead of trying to time the market, focus on timing the market. This means staying invested over the long term. Remember, investing is a marathon, not a sprint. Patience and consistency are key. The stock market has historically trended upwards over the long term. Despite short-term volatility, the overall trajectory is positive. By staying invested and riding out the ups and downs, you're more likely to come out ahead. It's about weathering the storm. Think of it like this. Would you rather buy a house when prices are low and sell it when they go up? Timing the market is like trying to guess when that will happen. Or would you rather buy high and sell low? This is often the result of trying to time the market. The same logic applies to investing. Consistency and patience often yield better results. Don't try to be a hero. Avoid the temptation to make impulsive decisions based on short-term market movements. Stay invested, stay disciplined, and let the market do its thing. Over time, this approach has proven to be more successful. You know the saying, don't put all your eggs in one basket. Well, that applies to investing too. Diversification is key to managing risk and protecting your portfolio. Imagine putting all your money into a single stock. If that stock tanks, you're in big trouble. But if you spread your investments across different asset classes, like stocks, bonds, real estate, and maybe even some alternative investments, you're less likely to be wiped out by a single event. Think of it like this. If one investment is down, another might be up, helping to balance out your overall returns. Diversification helps you weather market storms and come out stronger on the other side. It's about finding the right balance for your risk tolerance and financial goals. Okay, this one might seem boring, but trust me, it's important. Fees can eat into your returns like crazy if you're not careful. Every dollar you pay in fees is a dollar less that's working for you. That's why I'm a huge fan of low-cost index funds. They track a specific market index, like the S&P 500, and they have super low fees compared to actively managed funds. Think of it this way. If you're paying a 2% annual fee on your investments, that might not seem like much. But over time, those fees can add up to tens of thousands of dollars in lost potential earnings. Always check the expense ratios of any investment you're considering. Lower fees mean more money in your pocket in the long run. This is probably the hardest mistake to avoid because we're all human and we all have emotions. But when it comes to investing, letting your emotions guide your decisions is a recipe for disaster. Fear and greed are the two biggest culprits. When the market is down, fear can lead you to sell everything at a loss. And when the market is up, greed can tempt you to make risky bets. The key is to stay disciplined and stick to your long-term strategy. Remember why you're investing in the first place. Is it for retirement, a down payment on a house, your kids' education? Having a clear financial plan and sticking to it will help you stay the course, even when the market throws you curveballs. That's it for today's video. I hope you enjoyed it and found the information valuable. I hope you found these tips helpful. Remember, the key to successful investing is continuous learning and staying informed. Remember, investing doesn't have to be scary or complicated. With the right knowledge and strategies, anyone can become a successful investor. By avoiding these common mistakes, you can set yourself up for financial success. It's all about making informed decisions and staying disciplined. If you found this video helpful, please give it a thumbs up and subscribe to my channel for more investing tips and tricks. Your support means a lot and helps me create more content for you. And be sure to hit that notification bell so you don't miss any future uploads. This way, you'll always stay updated with the latest tips and strategies. Now, I want to hear from you. Your experiences and insights are incredibly valuable. Have you made any of these investing mistakes in the past? It's okay. We all learn from our mistakes. How did you overcome them? Sharing your journey can help others avoid the same pitfalls. Share your experiences in the comments below. Let's create a space where we can all learn and grow together. Let's learn from each other and build a community of smart investors. Together, we can achieve great things. I'll see you in the next video. Thanks for watching. Your support and engagement mean the world to me. If you found this video helpful, give it a thumbs up and subscribe for more investing tips. Your feedback helps me improve and bring you better content. Comment below if you've made any of these mistakes and how you overcame them. Your stories can inspire and guide others. See you in the next video. Until then, happy investing and take care.